Who is the greatest investor of all time? Is it Warren Buffett, Ray Dalio, George Soros, or some other investor? This could be considered the pantheon of great investors if it wasn't missing Renaissance's founder, Jim Simons, who should be considered the world's most successful investor. His legendary medallion fund has returned 39.1% on average per year since 1988, generating over $104 billion of trading profits. Even better, he is showing no signs of slowing down. Renaissance is often excluded from the best hedge fund list because its well-known medallion fund's results are hard to verify, as it has been closed to outside investors since 2003. But there is undeniable evidence that the returns are very real. For example, when an employee was fired in 2017, he negotiated into his settlement a clause that allowed him to stay invested in the medallion fund, which has produced otherworldly returns since 1988. Other facts showing legitimacy is that Renaissance would be the world's worst Ponzi scheme, as it does not allow in outside money. In addition, Securities and Exchange Commission evidence shows it manages over $100 billion of assets, and it confirms its famous 544 structure, which is likely the highest fee structure in the world. This means an investor pays 5% of his assets each year and 44% of his profits to Simons. Even at this structure, investors would line up to invest in Renaissance if it was open to outsiders. Simons' wealth did not come out of thin air, and Renaissance's strong returns has made him one of the richest people in the world. Finally, the IRS is asking for $6.8 billion in back taxes. The IRS believes the strategy used from 2000 to 2015 was for tax avoidance. Renaissance disagrees, but the dispute has not yet been settled. Simons, now 81, is eccentric, despite keeping a low and secretive profile. His secretive personality may have developed when he worked for the Institute for Defense Analysis from 1964 to 1968. Simons remembers not even telling his wife, soon-to-be ex-wife, what he did there. But we now know his task was to decode Soviet messages. Simons' eccentricity shines through during this 2019 interview, where he receives a phone call.
So, when did you first get interested in business? When you were at MIT, you mentioned something about that last week.
I'll have to call you back. What can I say?
He earned more than any hedge fund manager in 2017, with $1.7 billion of fees, and again with $1.6 billion in 2018. Renaissance's strategies are standing the test of time, better than any other legendary active fund, such as Ray Dalio, whose famous Pure Alpha fund has struggled compared to the S&P 500 since the financial crisis. Warren Buffett has made many recent investment mistakes, including his investment in IBM and Kraft Heinz. Buffett's firm has only slightly better results than the S&P 500 since the Great Recession, and this is excluding the incomplete 2019 year, where Berkshire Hathaway is badly losing. So how has Simon continued to have so much success? This video will go through his exciting life. His firm Renaissance Technologies should go down as the greatest fund of all time. Before we start the video, if you like this type of video, please hit the like button or subscribe so that we can trigger the YouTube algorithm. Also, you can follow us on our website, themarketisopen.com. We publish original news articles, and we also have a message board where you can post articles, or you can follow us here. Jim Simons was born in Massachusetts in 1938. He was a spacey prodigy and was often daydreaming about a math problem. At 14, he remembers enjoying a part-time job sweeping floors, as it allowed him time to think. In 1955, he started an undergraduate degree at the Massachusetts Institute for Technology, or MIT. Simons was a very cocky student. In his second year, he registered for a graduate-level course in abstract algebra. He almost failed the course, but he would spend the entire summer studying and blossom the next year. In 1958, he graduated from MIT with a Bachelor of Science in Mathematics. Simons' first real taste of investing was in 1959, when he received a $5,000 wedding gift. Eager to multiply the money, he drove over to Merrill Lynch asking for investment ideas. It put him in 2 stocks, but Simons was disappointed by the lack of excitement. He then asked Lynch if it had anything more for a risk-taking investor. It recommended soybean futures, which were trading at $2.50 a bushel. A future is an agreement to buy or sell an asset, typically a commodity, at a predetermined price. A future is similar to a forward contract, but the difference is the physical commodity never exchanges hands. For example, if one were to buy a future due next month at $2.50, assuming the price went to $3, the other party would owe 50 cents when the contract expires. If it was a forward, then it would be settled by buying physical soybeans. Futures are risky because they typically involve a large amount of leverage. Simons bought 2 contracts, and each contract was based on the value of 5,000 bushels, Luckily, soybeans quickly increased to $3, giving Simons a 50-cent profit per bushel, or $5,000. Despite his success, the position could have led to $25,000 in losses because of the leverage in the position. However, his PhD thesis was suffering given the time constraints that trading was putting on him. So he put his trading career on hold for the rest of his PhD. He then solved a difficult math problem, which landed him a prestigious job at Harvard. However, he found the teaching life to be rather dull, and at 26, he left for the IDA, a government agency which sought to break intercepted coded Soviet messages. At the IDA, Simons worked with many other skilled mathematicians. In addition, the IDA allowed employees to work up to half their time on their own personal math work. Simons flourished, but he realized some of the other mathematicians were technically stronger than him, but he still believed he was more creative. This led him to start iStar in 1966, which was a firm that would electronically trade stocks. Though, this firm abruptly closed because his bosses did not appreciate the multitasking. In 1968, Simons published an internal IDA paper exploring how a quant firm could make 50% a year. Simons proposed using a hidden Markov model, which is the same as a Markov model, just it simply has some hidden information. For example, say it was sunny yesterday. That would be the event. Also assume there is a pattern that sunny days predict future sunny days. Then, tomorrow's weather would be the hidden state. Therefore, a simple hidden Markov model could allow one to predict the weather. Lenny Baum, one of the strongest mathematicians at the IDA, developed a famous algorithm to find more events to better predict tomorrow's weather, or hidden states. For example, his data could also show that humidity predicted weather. His algorithm would become known as the Baum-Welch algorithm, which is still prominent today. Simons argued that this algorithm could identify many separate events to predict stock market behavior. But before implementing the strategy, Simons was fired in 1968 because of what he said during an interview. The cocky Simons said, "Because the IDA lets you spend half your time on your own work, and because I'm against the Vietnam War, I'll spend 0% of my time on their work until the war is over, and I will make it up after." He was immediately fired, and at 29 he was searching for his third career. Fortunately, Stony Brook University was looking for a chair of its math department. At Stony Brook, Simons' people skills flourished, as he was responsible for recruiting talent to grow its math department. He recruited well-known mathematicians like James Axe, who would later join his trading firm. Simons was strong at identifying and managing highly skilled employees. In 1976, he won America's top honor for geometry, and he had grown the department into a respectable force. But Simons was lusting for real wealth, and he was once again getting bored. He remembered the rush of trading soybeans in 1958, and he started investing in sugar based on a former student's algorithms. He would make 10 times his money, but the price of sugar collapsed soon after he withdrew, which was not predicted by the models. He was lucky, not skillful. But another strength of Simons was identifying when he was lucky. He was therefore motivated to improve his trading methods. Simons drifted away from Stony Brook. In 1977, he felt currencies represented a unique opportunity because the last remnants of the gold standard, known as the Bretton Woods Agreement, collapsed in 1971. And many major countries recently started floating their currencies. Floating just means that market forces determine the price. Watch how the market is changing the value of the US dollar right now relative to the euro. An opposite example is the Hong Kong government has been forcing a price of 7.8 Hong Kong dollars per US dollar since 1983. This type of exchange is known as a fixed exchange rate. With many new floating currencies, Simons felt there was an opportunity. He resigned from Stony Brook in 1978 and started Monometrics, which was a combination of two words, money and econometrics. At this time, his net worth was between $500,000 to $1 million. At his new firm, his learned recruiting skills were important, as he hired Lenny Baum, who worked with Simons at the IDA. Simons was able to convince Baum after showing him currency charts, which they both agreed showed clear patterns. He also hired James Axe, who worked with Simons at Stony Brook. Monometrics raised $4 million from outside investors. Its early models used mostly intuition, as computing power was still weak. Its first big gain came in 1979. Lenny Baum theorized that Margaret Thatcher, then the Prime Minister of the UK, was holding down the British pound, and it was poised to spike. Simons mockingly told Baum,
"I wish you'd come here this morning." He said, "Why?" I said, "Because Margaret Thatcher just stood up." And
However, Baum said the pound would rise even more. The firm ended up scoring a 50% gain on that trade and gained 100% in 1979. But Simons was not satisfied that they were relying mostly on intuition. He started collecting price data as far back as he could find. Despite not yet integrating the data, the funds soared 6 times in 1980. His net worth was now between $6 to $12 million. Simons now became a bit of a renaissance man by investing in tech startups. Because of the strategy change of investing in tech startups, Monometrics was renamed to Renaissance Technologies. Still relying on intuition, Baum purchased gold and ignored Simons' advice to sell after it spiked. In early 1980, Simons learned that there were lines of people trying to sell their gold. He told Baum,
"Sell the gold." He said, "No, you don't know how far it's going." I was the boss, and I said, "Sell the effing gold." He said, okay.
He was once again blessed with excellent luck, not skill, as the price of gold collapsed after they sold it. In 1984, Baum's stubbornness did eventually cost the firm 40%, and the two agreed to go their separate ways. Simons would now rely on James Axe, the firm's other star mathematician, who preferred algorithms to intuition. His mid-1980s strategy was to look for pairs of currencies or bonds that tended to move together. Renaissance would then buy the currency or commodity that didn't rise as much and sell short the one that rose more. This is a reversion to the mean strategy that Renaissance likely still uses today. This strategy is like predicting a baseball player that is hitting 500 over a certain stretch of games will soon fall back to his usual average, say 300, by going through a transition period of hitting lower than 300. Axe expanded the firm's quantitative methods by using kernel methods, allowing its computers to find non-linear patterns. For example, a human can easily find the missing part of this pattern, but a machine at this time couldn't because the pattern was non-linear. Teaching the computer to identify non-linear patterns was valuable, as this type of pattern won't always be so easy for a human to see. Renaissance could now find patterns in higher dimensions. Despite this success, the firm was returning only 20% a year, far from the 50% a year that Simons predicted in his 1968 paper. This critique of Axe led to a falling out, and Axe left the firm. Elwin Berlekamp, another famous mathematician, would replace him. He told Simons to focus on short-term trades because the law of large numbers would allow the firm to be right only slightly more than wrong, producing steady profits. With this change in strategy, Renaissance's results have been on a rocket ship. It returned 78% before fees in 1990, and it has not returned less than 31.5% since. The firm continued to add trades by finding more patterns. It found that assets tended to move the same on Friday and Monday. The firm would then buy or sell investments late Friday, knowing the pattern often continued into Monday. In the early 1990s, Renaissance had conquered currency, commodity, and bond trading, but it was not making large profits trading stocks. The former markets had less liquidity, and Simons sought to enter the lucrative stock market in order to manage more money. In 1993, he hired 2-star IBM language programmers, Bob Mercer and Peter Brown. In 1995, the plan paid off, as the two had a breakthrough. The firm was now able to grow from 30 million to nearly 2 billion of assets under management by the end of the decade. Despite its 1990s success, Renaissance was overshadowed by another quant firm, Long-Term Capital Management, or LTCM. LTCM was also led by PhDs, but its PhDs also had Nobel Prizes. In fact, Myron Scholes co-developed the famous Black-Scholes option pricing model. However, LTCM was less secretive, and its core strategies were uncovered. One trade that LTCM liked was to short new US Treasuries and buy older issues. It found that new issues were often priced at a premium, and the firm could make money through arbitrage. But because these returns were so small, it had to use a tremendous amount of leverage. It borrowed $124.5 billion compared to its $4.5 billion of equity, or a staggering 25-to-1 ratio. Leverage amplifies returns, but it also amplifies risk. But LTCM returned 21% in 95, 43% in 96, 41% in 97, but in 1998 it imploded. It had to be recapitalized by banks in order to avoid a bond market contagion. Simons felt that LTCM was arrogant for several reasons. First, once its core trades became well known, it shifted to more obscure strategies such as Danish mortgages. Secondly, it had too much confidence in its models. Simons never believed that models were reality, but a version of reality. And Renaissance often reduced its positions when it suffered big losses. With full confidence in its models, LTCM continued to add to its positions despite mounting losses, while Renaissance appreciated big data more and continued to have success. In 2001, Simons said the firm downloaded 1 terabyte of information and made 150 to 300,000 trades per day. In 2003, Renaissance increased its fees to its famous 544 structure. it also kicked out all outside investors. Renaissance still has an upper limit on what its core fund Medallion can manage, which seems to be around 10 billion. If it was much larger, then trading could move the markets, limiting its gains. In 2003, with outside investors gone, Renaissance employees could now make more gains for themselves. But in 2005, Simon somewhat relented, and Renaissance launched Renaissance Institutional Equity Fund, or REIF, which as of 2019 manages 27 billion and is still open to outside investors. Renaissance also launched 2 new funds in 2012 and 2016. As we moved through the 2000s, we were seeing the golden age for quantitative investment firms. Goldman Sachs's Quantitative Investment Strategy Unit, or QIS, was in fact larger in 2007 than it is today. A little-known event occurred in August 2007, known as the Quant Quake, demolishing many firms and ending this golden age for the time being. Goldman's epilogue was that too many quant funds had the same strategies, and panic selling created a quake. But it said that this would unlikely happen in 2019, as there are more strategies, but this remains to be seen. Renaissance also lost a lot of money during the 2007 quake, but Simons used his intuition and reduced the firm's trading positions that were doing badly. He also reduced positions during the tech crash when Renaissance was also losing money. He often used intuition in irregular market trading times, as he didn't want to suffer the same fate as long-term capital management, which vanished into history as a rather disgraced fund. Medallion soon recovered, returning a staggering 137% that year. But things weren't all good. Its new fund, REIF, lost money, and in 2009, it lost another 5%, compared to the 27% gain in the S&P 500. Investors then fled REIF, realizing it was not Medallion. REIF was set up to make long-term trades, as to not interfere with the short-term trades of Medallion. REIF's original promise was to beat the S&P 500 by a few percentage points a year. As investors fled, REIF's assets dropped from 30 billion to under 5 billion. Since then, it has mostly recovered. In 2019, it now manages approximately 27 billion of assets and has beat the S&P 500 in most years since 2010. Renaissance's Star Medallion Fund has continued to have unparalleled success. During the financial crisis of 2008, while the market dropped 37%, Medallion returned 152% before fees, its best year ever. It continues to make returns at a breathtaking pace. Simon stepped down as CEO of Renaissance in 2009, leaving the company to be managed by the IBM pair. Renaissance and Simons have a profound legacy and show no signs of slowing down. While legendary investors, such as Ray Dalio and Warren Buffett, have suffered lower returns in recent years. For example, Warren Buffett has struggled since 2010, making many dreadful investments and barely beating the S&P 500, and will likely be worse once 2019 ends. Ray Dalio's Pure Alpha Fund has returned only 6% a year since 2009, compared to the 12% average of the S&P 500. So while these two are struggling, Renaissance is flourishing. So who is the best investor ever? One argument for Buffett is that he has been able to compound the returns. One flaw with Renaissance is that it can only manage a finite amount of money. Buffett's firm, Berkshire Hathaway, is now worth over $530 billion. Another negative for Renaissance is its returns are pre-tax. Berkshire Hathaway strategies allow for tax deferral. Renaissance has a very poor tax strategy, as its short-term trades have the highest possible capital gains tax at 39.5%. Whether you like Buffett or Simons, these two should go down in history, and Simons deserves to be in the same sentence as Buffett, maybe even ahead of him, because Simon's strategies are better standing the test of time. I hope you enjoyed this video as we explored Renaissance Technologies, the secretive quant fund. If you liked the video, please hit the like button and visit our website. So what is Renaissance's strategy? Since Renaissance is so secretive, we can only make educated guesses to what it really does. We have outlined 5 themes. The first is technical analysis. While Renaissance does not use the voodoo magic of most technical traders, who look for esoteric patterns, such as the head and shoulders pattern, can you imagine someone looking at this and saying, I see a pattern? But worse, even if there was a pattern, how is this scientific? Simon's fund tests patterns for statistical significance. Most traders do not, and are always going on intuition on what looks like a pattern. Second, it uses a reversion to the mean strategy, which looks for pairs of investments that usually move similarly. This strategy is a good one and is likely still used. Third, it finds patterns using its data treasure trove. It can then correlate how price changes usually move off economic events or articles. Patterns can be found using algorithms like the Baum-Welch. 4, its main Medallion fund uses short-term strategies, allowing the firm to benefit from the law of large numbers. With many trades, it only has to be right a little more than wrong to make huge profits. Finally, Renaissance has a human face. In certain crashes, such as the tech bubble and the quant quake, Simons came in and reduced the firm's positions. Statistics are not reality, said Simons. They are just a way of showing reality. Thank you for watching the video. Please subscribe to our channel if you liked the video. Also, please visit our second channel, TMIO Tesla, if you enjoy Tesla videos.